please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Then invite our market master, S Krishna Kumar, CIO of Equity, Sundaram Mutual Fund, now joins us. Krishna, good morning. You have, of course, been known as someone who's created a lot of wealth in mid-caps. How are you looking at this phase of underperformance of mid-caps and small caps in particular over the last 3 to 6 months?
Yeah, clearly, the euphoric wave that swept up all the small caps and some of the smaller mid caps to kind of all-time highs and significant overvaluations is giving way as you hit, some of the weaker macros and some amount of liquidity drying from overseas. So clearly, in the last, 6 months, we have seen a clear divergence. These large caps outperforming small caps by about more than 20% to 25% across a different comparative bunch of stocks. But clearly, the valuation premium that the small caps enjoyed over the Nifty, etc., has shrunk, and it's basically the BSE small cap index on a 1 year forward is now at a discount to the Nifty or the Sensex. So clearly, to a large extent, I think this excessive valuations have drained out. And if you look at, the small and mid caps have a good earnings trajectory going ahead. The micros, the corporate fundamentals have been improving. So I think from here on, you would find that the financials, the growth, earnings growth in these companies would be the ones to watch out for, and which will be supportive of the returns that the small cap segment would deliver. So we remain quite constructive here at this point in time. I think a lot of money is made when there is fear, and I think clearly in the small cap space now that's very true.
Okay, yes, as they say, buy when the street is fearful. Krishna, hi, good morning, and thanks for joining us. You've really created a lot of wealth for investors in several of your funds, whether it is with names, like Hitachi Homes, Arvind, Exide, Mahindra CIE, etc. These have been huge wealth creators in the past. But going ahead, would you continue to stick with some of these themes like auto ancillaries, cement, etc.? Or do you think that new leadership will emerge now, even within the mid-cap and small-cap space?
See, I think, I wouldn't think that there is going to be a leadership that's going to emerge in terms of some sector at this point in time. Given the kind of growth that is more diversified across various sectors, given that the economy is doing well on all fronts, I would rather stick with a lot more diversified kind of a portfolio approach. Though you will definitely find that consumption is definitely an overarching theme across various portfolios that we run, which will span across auto components, lifestyle products, retail, apparels, brands, and entertainment and holidaying. So that's a pretty broad subsets that we think we will play with, and retail credit also fits into that overall optimistic area that we play in. So I think it's largely a diversified portfolio approach because even the infra sectors have been coming back. Cement or if you look at the EPC construction companies, they've been doing very well. One of the best order books that you have seen with them. The book-to-bill ratio is quite healthy. So overall, I think it's going to be more a diversified approach. You may say that probably the industrials and capital goods will probably come back into limelight over the next 12 months because that's a sector which has not done well, but we believe that there are initial green shoots that are there in terms of orders coming into as the private sector starts to investing in for growth at this point in time.
Okay, Krishna, morning. How are you looking at tier 2 IT specifically for your mid-cap fund? I mean, the big boys have had this absolute dream innings, even the mid-cap companies actually. What would the call be as we look at the next 12 months?
I think, IT relatively has played out well, given the kind of support they had from strong free cash flows and valuations. I think that was probably the entry argument. And then with improved growth outlook and weakening rupee, I think a lot of the trade is played out. Henceforth, I think, we would look at IT as more, neutral to the market in the mid-cap space than being a big, driver of alpha in the next 12 months. So we would be very selective there.
Okay, by the way, the consumption story continues. So today also we have Dabur, Colgate making new highs. Not just this, Krishna, the Jubilants of the world's been making new highs. Bajaj Finance been making new high. The point I'm trying to make here is that the quality stocks are getting more and more expensive. So as an investor, as a fund manager, what should one do in a market like this, where there's a select set of 20 or 30 stocks making new highs and making a bit of a mockery of near-term valuations?
Yeah, I think like we discussed last time around, whether be it mid caps or small caps or larger companies, clearly, during these kind of times when there is uncertainty from macros and from global liquidity that we are seeing, I think there would be a move towards being a lot more defensive, and getting defensive across sectors would mean probably even in an industrial sector or infra, I think going to companies with better balance sheets, better promoters, and companies which have some kind of competitive edge in the markets. So I think that's where I think the markets are moving to. I think there is a premium for having low beta in this market conditions when volatility is really increased in the last 6 months. So I think that's the trade. And if you look at the portfolio that you mentioned, in terms of names that you talked about, many of our portfolios are hinged on portfolio companies which have strong balance sheets, good promoters, some kind of a strong business moat, which keeps these companies fairly insulated during tough times and enable these companies to still outgrow the market and maintain profitability. So I think that's why if you do look at some of funds like a mid-cap fund, the fund has outperformed the benchmark by about more than 3% in the current calendar year. That is reflective of the quality of the portfolio, and I think that's how I think the next 1 year would shape up when there are pressures on different fronts that we see.